In anti-money laundering context, risk refers to the likelihood or probability that a financial institution or organization will become involved in facilitating money laundering or terrorist financing activities. This risk can arise from various factors such as the types of customers served, the products or services offered, the geographic locations of operations, and the effectiveness of internal controls and compliance measures. The goal of AML risk management is to identify, assess, and mitigate these risks to prevent illicit activities and comply with regulatory requirements. Financial institutions face the risk of being used by high-risk customers, such as politically exposed persons, individuals from high-risk jurisdictions, or customers with unclear sources of wealth, who may be involved in money laundering or other illicit activities. In the context of anti-money laundering, customer risk refers to the potential for customers to engage in activities related to money laundering or terrorist financing. Examples include customers from high-risk countries with weak AML regulations, politically exposed persons who are senior officials susceptible to corruption, and customers involved in complex or unusually large transactions without clear, legitimate purposes. Risk is also higher for customers operating in cash-intensive businesses, such as casinos, car dealerships, or jewelry stores, and for those engaging in non-face-to-face transactions, increasing the risk of identity fraud. Additional risks involve customers whose beneficial ownership is difficult to determine, such as those using shell companies or trusts, and high-net-worth individuals who may engage in sophisticated laundering schemes. Frequent cross-border transactions, especially with countries known for banking secrecy, and businesses with unclear models further heighten risk. Moreover, customers frequently changing account details can indicate attempts to evade detection. Identifying and monitoring these risk factors is crucial for financial institutions to comply with AML regulations and prevent money laundering activities. Certain financial products or services may pose higher risk for money laundering, such as correspondent banking relationships, prepaid cards, or private banking services due to their anonymity, complexity, or lack of transparency. In AML, product risk refers to the potential for certain financial products and services to be misused for money laundering or terrorist financing. Examples of high-risk products include anonymous accounts, such as numbered accounts that conceal the identity of the holder, and prepaid cards that can be used anonymously or loaded with significant amounts of money. International wire transfers are also high risk, especially when involving jurisdictions with weak AML regulations. Other risky products include private banking services, which cater to high-net-worth individuals and offer high levels of confidentiality, and trade finance services, where the complexity of transactions can obscure illicit activities. Identifying and managing these product risks are essential to prevent financial institutions from being exploited for illegal purposes. Operating in or dealing with customers from jurisdictions known for weak AML CFT, combating the financing of terrorism, controls, or high levels of corruption increases the risk of exposure to money laundering activities. Geographic risk in AML refers to the higher potential for money laundering or terrorist financing in certain locations. Examples include high-risk jurisdictions identified by the FATF for weak AML controls, sanctioned countries evading restrictions, and tax havens with banking secrecy. Conflict zones with political instability and emerging markets with rapid financial growth but weak AML frameworks also pose risks. Additionally, regions known for illegal drug production or trafficking, such as parts of Latin America and Southeast Asia, are high risk. Monitoring these risks is essential for financial institutions to ensure AML compliance and prevent illicit activities. Unusual or suspicious transactions, such as large cash deposits, frequent round-figure transactions, or transactions involving multiple jurisdictions with no apparent economic or lawful purpose, pose a risk of money laundering. Transactional risk in AML refers to the potential misuse of financial transactions for money laundering or terrorist financing. Examples include unusually large cash deposits that are inconsistent with the customer's profile, frequent or unusual transfers between accounts, especially across different jurisdictions, and complex transactions designed to obscure the origin of funds. Other risks involve structuring or smurfing, where large sums are broken into smaller amounts to avoid detection, and the rapid movement of funds between accounts without a clear business purpose. Monitoring these risks is crucial for financial institutions to detect and prevent illicit activities. Regulatory risk in AML refers to the potential for financial institutions to face penalties, sanctions, or reputational damage due to non-compliance with AML regulations. Examples include failing to conduct proper customer due diligence, inadequate monitoring and reporting of suspicious transactions, non-compliance with international sanctions, and insufficient internal controls or training programs to prevent money laundering. Additionally, failing to update AML policies in response to new regulations or emerging threats can also pose significant regulatory risks. Regulatory risk in AML involves the potential consequences for financial institutions failing to comply with AML regulations, such as penalties, sanctions, and reputational damage. Examples include insufficient customer due diligence, inadequate monitoring and reporting of suspicious activities, non-compliance with international sanctions, and weak internal controls or staff training. Furthermore, neglecting to update AML policies in response to new regulations or emerging threats exacerbates these risks. Effective management and compliance are essential to mitigate these regulatory risks and ensure adherence to AML standards. Inadequate cybersecurity measures or vulnerabilities in technological systems increase the risk of money laundering through online channels, such as mobile banking, digital wallets, or cryptocurrency transactions. Technology risk in AML refers to the potential for technological systems and tools to be misused or fail, leading to vulnerabilities in detecting and preventing money laundering. For example, reliance on outdated software for transaction monitoring can result in missed suspicious activity patterns or false positives, overwhelming compliance teams, and allowing illicit transactions to go unnoticed. Additionally, cyber attacks on AML systems can compromise sensitive data and disrupt the ability to effectively monitor and report suspicious activities. Ensuring robust, up-to-date technological solutions and cybersecurity measures is crucial to mitigate these risks and maintain effective AML compliance. Insider threats, collusion with customers or third parties, or inadequate training and awareness among employees can facilitate money laundering activities within financial institutions. Employee risk in AML refers to the potential for staff to engage in or enable money laundering activities, either through negligence or malicious intent. For example, an employee might fail to conduct adequate customer due diligence or overlook suspicious transactions due to lack of training or awareness, leading to regulatory non-compliance. In more severe cases, an insider could collude with criminals to bypass AML controls for personal gain. Ensuring comprehensive training, clear policies, and regular audits are essential to mitigate employee risk and maintain robust AML defenses. These are just a few examples of the diverse range of risks that financial institutions need to consider and manage effectively in their AML efforts. Thank you for watching.